Start. Good afternoon, everyone. Can everyone hear me okay? Okay. Um, so today we are here to welcome Parametric, a subsidiary of Morgan Stanley. They're hosting today's Investment Innovation Series. Some housekeeping items. We're going to keep, if everyone will make sure their audio is muted, that would be wonderful. We also, if you can see the chat room icon at the bottom, we'd love to take questions or comments through that. If you can't see it, you can go ahead and email myself, T. Fyerson at cfawashington.org. I was the one, it should be the email that the link was sent to you through. You can send any questions and I'll be monitoring email that way. And we'll stop the conversation or continue with questions at the end of the session. So once again, we'd like to thank Parametric, a subsidiary of Morgan Stanley, for hosting today's webinar. And today we have Greg Bauer, the Executive Director of Institutional, and Dale Rosenthal, the Director of Derivative Research. And I'm going to let Greg go ahead and take it from here. And once again, if you all have any questions, please use the chat room or please email T. Fyerson, F-I-R-E-I-S-O-N at cfawashington.org. Thank you.
Fantastic. Thank you, Tiffany. Hello, my name is Greg Bauer. As Tiffany mentioned, I work on the business development team at Parametric, and I'm joined by Dale Rosenthal, who focuses on derivative research at Parametric. For those of you that don't know Parametric, we've been building custom solutions for over 35 years and currently manage over 150 billion in derivative-based solutions for our clients. I wanted to thank you for joining us today to learn more about the research Dale has done on how liquid factors can be used to assess a portfolio's risk. The factor model we are introducing uses the returns of the portfolio being analyzed and the returns of liquid and transparent factors. The clients and prospects we've been working with to implement the usage of liquid factor model have appreciated the complementary nature of the return-based risk profile to the more commonly used holdings-based analysis to determine the risk posture of the portfolio. So for example, one of the benefits of our approach is the statistical significance we can attribute to the liquid factors to help prioritize which risks to mitigate first, which has really been a benefit to many of our clients. So while we'll be covering a lot of statistics used to support the research, I know Dale will keep this engaging, but please feel free to ask questions using either the chat function or emailing Tiffany. So hopefully we can make this more of an interactive session. Maybe with that, I'll hand it over to you, Dale.
All right, thanks, Greg. Thanks to Tiffany and CFA Society of Washington for having us come give a talk. I think it's been a topic that's been really useful for us, and I've gotten a lot of good feedback, CQA and a few other places. So, definitely glad to be able to present it and hear what you guys think. Now, Greg, I believe you're my master of slides, are you?
I will be controlling it, yes.
Wonderful. Okay. So I want to talk to you guys a bit about risk models because we do a lot of work with regression models, and we're typically describing returns, assessing risks, and we think about if we have a good model. And it's not really we don't really mean that like a Boolean question. We're not just yes or no. There's some things we think about when we talk about, is the model good? It's not just, if you were to go to some of the AI and ML crowd, they say, well, look, it fits the data really well. And that's not what we mean, right? We typically want meaning from the individual covariates in our models. We even give them a different term. We call them factors. And a lot of times we're asking questions, are all these coefficients significant, or are the important ones significant? If you think you've got an equity fund and it doesn't seem to have any equity market exposure, you'd probably say, something's wrong here. And inbuilt into all of that is a little bit of kind of domain knowledge. Like we know about investments, we know about risks. We sit in this world of financial economics, and when we build these models, a lot of times we're going to take what we get and we're going to maybe monitor. We think of these as exposures. And so we're going to monitor these exposures. We might hedge them even. Um, and we run into some problems right away. There are some factor models out there, some really famous ones, where hedging the factors can be really costly or it can be tough. It may even be impossible. We can build factors for illiquidity. We can't hedge it. You can just avoid it, right? Um, you know, Fama French models, we can hedge those factors, but they're kind of expensive to hedge if you follow their construction. Some of the factors in Bar and Aladdin are really hard to hedge. This is especially hard if you have a big portfolio. If you're a pension fund and endowment, you probably don't want to alter your portfolio to say, hey, we're going to do a transition, we're going to have turnover about 20-30%, and that'll fix things up, really isn't feasible for a lot of portfolios out there. We also have the problem that over time, we want to lean on these coefficients. We want to be able to trust them. And if our fund doesn't turn on a dime, right? It's a big, heavy ship, it turns slowly. We don't expect our exposures to turn on a dime. And so unstable coefficient estimates really kind of challenge how much trust we have. Um, it erodes our trust. A lot of times, if they're really unstable, we might get lower statistical significance. If we're hedging, what we really don't want is that we're changing our head constantly, even though it doesn't make much difference for our total risk. And that might seem strange, but if some of these factors are correlated, two of A and one of B versus one of A and two of B might be roughly the same thing. Why pay transaction costs to sort of switch between those? And so what we're really asking when we ask if the model's good is it meaningful and how is it meaningful? And how much do we trust it? Um, what we really want is we want factors that are meaningful so that they have some intuition that we can bring to it, and we think that they are going to be economically durable. We'd like the estimates to be stable, and ideally, we'd like them to be easy to hedge. So, you can hop ahead, Greg. Well, let me, I mentioned this idea that coefficient estimates can be unstable, and that's kind of key because we think of these estimates as really estimating factor exposures. And if the estimates are unstable, we start to doubt that. Um, Sometimes it's really easy to fix this up, right? There might be theory that just says, hey, choose a better variable. Don't look at the change in price, look at the percentage change or the log return, something like that. It can get more complicated though. We may have tossed a bunch of correlated variables into our model, like different points on the yield curve. And that gets really complicated because as our data changes, the model's going to lean on one or more of these variables, and it's going to shift its weight around, even when that maybe doesn't change the actual risk that much. Same thing if you have a large and a small cap index. If you're not careful how you work with these, you'll find it flipping between them, even though they're highly correlated, and so your actual risk isn't changing much. That's a real problem. And what we're really dealing with here a lot of times is what statisticians would call collinearity, what economists and econometricians call multicollinearity. We have correlated variables, and the model isn't sure which one to prefer. They're similar enough that with slightly different data samples as we roll across time, we'll put more weight on one versus the other. Um, that's a problem. We get unstable betas, we get inflated standard errors. So not only do we switch between variables, but even if we're still focusing largely on one variable, the standard error is bigger. And so it looks less significant. We have less trust in it because the model says, yeah, there's something else that's almost as good. So I don't know if this is the right one. And, we'd really like to know if we have the right one, right? Um, Especially if really our exposures to major risks didn't change. Um, because what's going to happen then is we're going to be hedging and re-hedging unnecessarily. We're not really changing our risk profile, but we're paying money for this slight adjustment. Um, there's different ways to look and assess if you have collinearity and a problem with that. Something really quick and dirty, it's not perfect, but you can just look at a covariance matrix or correlation matrix of your covariance, right? It's not perfect. It's not going to catch more complicated correlation structures, but sometimes it makes the problem really obvious. Um, So then the question is, what do we do with that? And there's a couple of things that we're going to do in this model that I'll show you. And I think they're useful in this model. They're useful in general. If you've worked with data, you've probably seen some of these things. One thing is we're going to do some feature engineering. I am of the opinion that you'll hear other people say that a lot of ML is repackaged statistics. It's old wine in new bottles. But the term feature engineering that ML gives us is really nice. It's a nice way of encapsulating this idea of thinking carefully about our data and how we bring it into the model. And so we're going to construct some variable combinations that are going to give us some stability across time and hopefully some separation between what these factors are. And then on top of that, where there's still some correlation in the system, still some collinearity, we're going to drive that out with a better way of doing estimation, something that I call tipples. It's sort of this theory implied partial least squares. Hermann Vold came up with partial least squares in 1960. He used it for cases where we don't know much about our variables. Here, we actually do know a lot about our variables, but we end up in the same situation. We have a preference. And so we're going to look at variables we prefer first. If you want to feel fancy, this is a form of shrinkage estimation. You can also say this is like boosting and machine learning. And then you check the box for fancy methods. There you go. You'll see it's pretty simple. So why am I going to suggest that we use some liquid factors? And why have they not been used? Um, there's a lot of good results in the literature that suggest factors that are tradable have more explanatory power. There is some look at a couple of these factors, and in general, the liquid factors beat those that were just tradable. And in particular, a really liquid expression of a factor versus something where you have to do portfolio construction like a Fama French factor, the liquid factor beat that tradable factor. There's also evidence that factors which are tradable, factors which are liquid, are less hurt by misspecification. So even if we get our model a little wrong, we're going to be a little bit robust to that. We also think that they have really durable economics. By being liquid and traded, they're forward-looking. If we think about how we create these, we can try to isolate different parts of risk, just different contributions. And ideally, we can get at forces that we're familiar with, forces that we can go back to, was it 1604 with, I'm looking at Joseph de la Vega's Confusion to Confusiones, talking about workings on the Amsterdam stock market and concerns that were in there, concerns that go back to the Code of Hammurabi. So we think these are pretty durable. They're going to persist over time. 100 years from now, a lot of these ideas, we might have a different way of expressing that factor, but the idea will still be there. And that's what we think makes the factors meaningful and sort of intuitive. So then the question is, well, why aren't these in a lot of the models we see? And that's actually largely, I think there's a historical accident there. When the Barra model was built, with Barra Rosenberg, when the Fama French models were first built, Chen Roll Ross, I mean, those were in the 70s, 80s, 90s. Liquid financial futures weren't that big. There were some financial futures contracts. I think there was a Ginnie Mae. We're starting to get the beginnings of some bond contracts. We had the S&P 500, but they weren't nearly as liquid as they are now. And so researchers, also, to be fair, academic researchers are typically looking backwards. So even if right then they were starting to become liquid, they're looking backwards and they didn't have something that went backwards. And so those didn't end up in their model. But we don't have, we do have liquid financial futures now. We have a lot of Delta One instruments we can use to hedge, and that's sort of nice. And so that's what we're gonna make use of that. So is there a question? No, okay. So
Você vai lá em maio, quando chegar o relatório, pode ser que seja, sei lá, 30 de maio.
is that a question? I'm sorry, I didn't hear. Very faint.
Can everyone make sure you're muted, please?
There we go. Okay. So I'm gonna walk you through what these factors are. I'm going to show you these in a US context, but I'm also going to suggest, I'm going to mention that a lot of these are available in other contexts. And that's sort of a benefit of the growth of Delta One products and, sort of more competitive markets in the US with Reg NMS that led to MiFID. Um, and so, this isn't just a US story. But in the US, no controversy. Our first factor, if we're looking at equity portfolios, our basic equity index, it's going to be the excess returns on the S&P 500, right? It's ironic. A lot of times when we do the CAPM or when we do a Fama French model, people will use this, even though if you actually read Fama and French's work, they're using an equally weighted index from CRISP. What's the difference between that and the S&P 500? Usually on your beta, it's like 0.01, 0.02. It's usually not big, right? And this is easy. We see this everywhere. And that's where but then I'm going to depart a little bit. For a size index, I'm just going to take the Russell 2000 minus the S&P 500, right? That's our size index. It's two instruments. You can literally pull this up on your phone. Hey, Russell's up 80 basis points. S&P's up 40. Okay, so the size factor is up 40 basis points, right? Easy to do. You could do this walking through an airport. And if you know the beta for your portfolio on size, right there, you have a rough idea, first order approximation of how much your portfolio moved. For the value factor, I'm going to take the Russell 1000 value and growth indices, subtract, the growth off the value, the difference between those. Again, active futures traded on all of these. And that's nice because we can hedge these easily. And then I'm going to go with the work of Litterman and Schenkman. We're going to use changes in the yield curve level, slope, and curvature, what I call a bump factor. If you've seen some different yield curve models like 2+ row, you would know that. And just looking at some key points, 3-month, 2, 5, 10, and 30, right? Average change across those, that's going to give us something that's like duration. I mean, technically DV01, right? DV01 is the dollar value of, a 1 basis point shift in the yield curve up and down, up or down. So we're going to get something out that's like an effective duration, since we're in return space. And then the slope factor is sort of a 30 versus 3, a 10 versus 2. Those are constructed to have 0 duration. So that's not going to interfere with this duration factor. It's not going to be collinear. And then the bump being a difference in slopes. That's sort of 30 to 5 and 5 to 3. That has no exposure to the slope coefficient. So these are constructed to at least mechanically be, orthogonal, to not be correlated. Now, there is an issue in financial markets. We know that volatility relates to returns. If you read some of the work from Litterman, you know that the sort of curvature or bump factor with yield curves does relate a little bit to interest rate volatility. So we might expect to see some correlation that's not mechanical between the level and the bump factor. You can build versions of these in the UK. You can build versions of these in Europe, with the Stocks Europe 600 and the MSCI Europe Small Cap. There's futures traded on both of those. The value factor is harder. We don't see that as much outside the US, but we can definitely get the yield curve factors. Those are our basics. Those are things that we've seen in a couple different models. And then I'll talk to you about, there's a few more factors that we have. So I'm going to also throw in some credit and some vol. And we sort of have vol in already for interest rate, for interest rates with that sort of bump factor. But I'm next going to look at the most liquid instrument we've got out there. If you talk to people on a corporate bond desk, a lot of them will use, sort of various instruments on the iBox, the sort of USD liquid investment grade index. There's a super active ETF on it, and there's also futures on that ETF. It's got roughly the duration of a 10-year, so I'm going to subtract off 10-year returns so that we have something that's 0 duration. Again, we don't want to have a mechanical correlation with one of these curve measures. And then I'm going to do the same thing with the high yield factor, the iBox high yield index. If you're a high yield issuer, you're probably not issuing as many 10 years though, and so that index tends to have about the duration of a 5-year. So pull out the 5-year, and we'll look at what that spread is above the IG factor, right? So we've got 2 credit factors, sort of IG and the high yield above IG. And then I'll look at break-even inflation, sort of tips versus treasuries, and equity volatility, the VIX, right? These are a little harder to localize, but we can do it. We, especially Europe and the UK, they have some active credit markets. We can get some instruments. A little tougher. Some of the factors that I mentioned before, we can create versions of those in Japan. Hard to get a value factor in Japan, though. Also hard to get IG and high yield factors. Even though, you would think equity volatility too. No, the UK, Europe, Japan, a number of places, South Korea, all have equity vol instruments. So VIX-like instruments have caught on, but the credit instruments haven't caught on yet. But this is nice. We can create versions of all these factors that are easy to pull up on your phone. The most complicated ones are the yield curve factors, where we're averaging changes in a few yields. That's it. I mean, there's nothing hidden. I've literally told you what the factors are. So it's all there for you to see. And then we're going to toss those into an estimation method that's based on partial least squares. Because hopefully what we've done, right, by pulling out, if you think about Russell minus S&P, we're pulling out maybe whatever general equity risk there is in both those indices, and hopefully that's just leaving the small cap part. So this should make these factors less correlated, but we're going to take it a step further. And we're going to use this idea of partial least squares. And when Hermann Wold did this, he had no idea what to do with this data. So he did sort of something like PCA, if you've done principal components analysis, trying to create some, sort of uncorrelated combinations of variables. We have economic intuition here. And so we have these factors. We've got some theory that guides us. And it's not high theory. We're not taking a look at the fund returns. It's just we know what factors, when we read financial news or when we read sort of dissections of what happened to a fund, we know what risks we're thinking about. Well, did rates move up? How did the equity markets do? Were small cap firms getting hurt? Was there a credit crunch? Did inflation spike up? Was vol high? Like, these are all things we've been thinking about for most of our career, right? But when it comes to hedging, there's some of these factors that we typically think of first. And so we have a preference ordering. If I'm trying to explain returns on an equity fund, I'm probably going to start with the S&P 500. And then I might look at a size and a value factor. And then I'll go and look at maybe yield curve factors and credit factors. And way down there maybe is vol. Most of these are, they're not portfolios that we think are exposed to options or convertible bonds. So we don't automatically think that vol is, after we explain the S&P, that vol is going to be key. If I'm looking at a bond portfolio, I'm going to go with the yield curve factors first, and then credit, and then I'll throw in the equity factors. Because if I have some corporate bonds, they do have some beta, sometimes 0.3 to 0.4 beta. And I do this, I literally just fit one factor at a time. I fit that factor, the one I prefer most. I take the residuals, and then I do my next regression with the next factor I like next most on those residuals. And I keep daisy chaining this until I'm done with my factors. What's also nice is I can sort of see incrementally how much R squared, what percentage of the variation I'm explaining with each factor, but I also get statistical significance out of these. So it's kind of nice. Now, there is a bias. Oh, there's a question, Tiffany?
Dale, there's a question.
Sure.
Which of these factors measure liquidity or illiquidity as such? This is from a little bit earlier, and I don't want to get too far ahead.
None of them measure liquidity. They're all very liquid. These are the most liquid instruments we could find. So when we're done with all these, with regressing all these factors, there's going to be residuals from that. If there's an illiquidity premium in there, it should still be in there because everything we've used is super liquid. There's futures traded on it, or you can trade them for really cheaply, like with government bonds. So to the extent that you think your returns are driven by an illiquidity premium, that should be there at the end. And, one of the things that we're thinking a lot about, and that's sort of avenues for future research, is what do we do once we've explained the returns with liquid factors? Then what do we do to explain what's left? And that's the idea, is that should come out there. You should also see if there's an effect from something being hard to borrow. That should also come out there. So limits to arbitrage, illiquidity, things like that should pop out at the end. And then we can try to find ways to explain that. So like I mentioned, this is a form of boosting. So if you want to say you're doing machine learning, you can. But it's also biased estimation because we're preferring to explain things like, say, for an equity portfolio with the S&P 500 first, we're going to get slightly different answers than if we just threw everything in together. And if you study stats, the one thing you'll hear with biased estimation is you have this bias, that's unfortunate, but you typically get lower variance. The unusual situation we find ourselves in is we actually have a preference. We want the bias. We want to use certain factors first. So this is the only since getting a PhD in stats, this is the only time I can think of where we actually where we want biased estimation and we actually have a preference for the bias. Kind of unusual. But hey, we're going to prefer more liquid hedging instruments, and that's sort of guided by theory. So this is mathematically okay. We do have consistency. We are projecting on the same space as if we threw everything in together, but we're just going to prefer certain factors to explain with first. That's the method. So I'm going to look at some data to show you a couple examples of this. I'm going to grab some data to build these factors, and I'm going to grab some fun data. And, this is just sort of summary statistics. I grabbed data from sort of 2015 through Q1 of 2024. And you can see, like I said, S&P 500, Russell 2000, Russell 1000 value and growth, 3-month, 2-year, 5-year, 10-year, 30-year, 5-year tips, and then the iBoxx IG and high yield and the VIX, right? You might notice here, for example, that if you look at 30-year, returns on the 30-year treasury, 15.5 vol. You can lose money trading bonds. This is always a surprise to my students when I taught investments. Similar volatility to what you see from sort of the S&P or whatever. But if you look at your sort of mins and maxes and everything here, nothing's standing out as a data error, which is good. Now, if we combine these into the factors like I've suggested, you're going to notice that for a lot of these factors, the volatility drops a lot versus what we saw. So yeah, the S&P 500, the excess returns are still basically the same vol. But this size factor, the Russell minus S&P, has about 11% vol, whereas the Russell before had a higher vol than the S&P, right, around 21%. So we've gotten rid of one of the sources of sort of volatility in there. Same thing with this sort of value minus growth. And then the yield curve factors, much lower volatility. Same thing if we look at sort of, if we're looking at this sort of the way that for those of you who've looked at fixed income, this IG10 factor, because we're working in return space, it's very much like the Venn-Dor factors, sort of duration times spread. That's basically what's going on there. And if you look, the volatility on those is a lot lower, as is break-even inflation. So something we're doing, there's lots of sources of risk in all these, but we're removing some of the common sources of risk from some of the factors after, the base level, like the S&P. That's good. And, mins and maxes aren't crazy, so things look sensible. I'm going to do some comparison with the Fama-French model, or Fama-French and Carhart, sort of 3 and 5 factor, 4 and 6 with momentum. And if you look at the volatilities here, not too different, right? The mins and maxes are similar. Now, these are done with sort of, SMB and HML are created with these 2-level portfolio sorts. If you played around with the 5-factor model, you'll know that you do those portfolio sorts in the 5-factor model. You're not doing, sort of 4-dimensional portfolio sorts with RMW and CMA. That would be pretty tough. You'd really hit the cursive dimensionality, but I'll give a little secret away a few slides ahead. What we are going to see is actually that does lead to some correlations in their model between factors, which I don't think they necessarily want, but there we go. So pretty similar to what we saw with the liquid factors that we created. I mentioned that you can have a really quick and dirty method is to look at a correlation matrix. So here, if you look on the left side at this correlation matrix, you can see some definite structure, right? We see this cluster of equity indices in the upper left, right? S&P, the Russell 1 value and growth. If you go across, well, I'll get to that in a second. A little down from there, you see this other block, right? And that's all the fixed income instruments. sort of everything from 3 month out to the 30-year, 5 month, your sort of 5-year tips. Because we're working the credit instruments, because we're working with returns instead of yield changes, that's why you see this opposite color, the red. But, if we were in yield spaces, you would see that also highly correlated with bonds. Interestingly, though, that's the IG index. If you look at the high yield index, it's actually got a lot more correlation with the equity indices. And if you ever talk to a high yield trader, sometimes they'll get seated next to equity traders or preferred traders. So that's we can see that here. And then the VIX having correlation with the equity indices. But there's a block structure there, which means that there's correlation among these, which means if we just throw these into the model could easily get confused. If you look over at the right-hand side, this is the result after doing the feature engineering. Notice that a lot of the saturation's gone away, right? We don't have high correlations between the S&P and our size or growth factor. We don't have very high correlations among our fixed income factors, except we do between, a little foreshadowing, the bump, which is that curvature, which is related to interest rate vol, and the level, changes in the level. Same thing, like we have some correlation between the VIX, changes in the VIX and changes in the S&P. So because we live in a mean variance world, there are relationships that pop up between volatility and returns, or, DV01 and interest rate volatility. But we've driven a lot of correlation out, right? If you look at the Fama-French factors, right, I've got, the 3-factor and the 5-factor factors in here because they're not exactly the same. You will see some differences. I believe it's the SMB factor, I think, is just about identical, if I remember right. But the HML factor is slightly different between the 3 and the 5. Not only that, you have, so we have high correlations between those, which we would expect, and between the liquid factors. But you do have this correlation between the CMA factor and, sort of HML. So if you're using the 5-factor model, there, that's like a 0.6 correlation. That's not something that you would want to ignore. But in general, we see a high correlation between the Fama-French factors and the liquid factors, this sort of size and value up here. To give you an idea, those are like, around 0.9 or higher. So that's good. That's good. So I'm going to just look at a large equity focused fund. It's done decently well, annualized volatility around, a little under 20%, but pretty decent returns. Nothing looks really crazy on the sort of min and the max. It's had some rough days. It's had some really good days. Nothing surprising for an equity exposed fund. And so what we're going to do is we're going to take the factors we've got, and we're going to sort of try to explain the returns of this fund with those factors. And I'm going to do this first in a weird way. And this is to show sort of some of the benefits of what we're doing. I'm going to first take all those liquid instruments that I use to create liquid factors, and I'm going to throw them all into the same model. And the reason I'm doing this is because there is a view out there sometimes that, we can just throw everything into the model and then recombine the factors after the fact. And that's sort of true and sort of not true. And so I think it's useful to see what happens if you have a model with a lot of collinearity sort of plaguing it and what we get. So that's sort of this kitchen sink model. I've thrown everything in there. We've got some weird betas. We've got a 2.35 beta with the S&P and a minus 1.2 with the Russell 1000 growth. That's odd. And you might in your head say, well, 2.35 minus 1.2, it's like a 1.15. Okay, I'll ask you to hold on to that thought. In the middle, this model in the middle is where we've done the feature this sort of feature engineering. We've created these liquid factors, but we've still thrown everything in together, right? And for one, we aren't getting a 1.15 beta with respect to the equity markets. We do see some factors that are sort of in bold here that are significant, but you might say, okay, well, I lost a little in R squared, I lost 2%, but this is a little easier to understand. The right-hand side is the full model, and we're going to do this sort of sequential shrinkage where we're going to go through factor by factor, right? So if we just try to explain returns with the S&P 500, excess returns on the S&P 500 first, we're going to get a 0.87 beta. It's a little different from that 1.15. Highly significant, right? Sort of T-stat of around 64. The size factor doesn't come out as significant. The value factor does. Pretty nice T-stats, 24, almost 25, right? And then we also seem to have some sensitivity to changes in the level of interest rates, right? The level of the yield curve. Not so much with the slope, not so much, I pop from there to sort of the credit instruments, because if you do PCA, that bump factor, that curvature factor usually doesn't explain a lot. Can explain something, but usually we go with credit factors next. Those don't seem to add much value, nor does the yield curve bump or break-even inflation. Maybe something from the VIX, right? Our R squared went from 77.1 down to 74.1. Not a huge loss, but we have some preference ordering we like. Okay. So we got a 0.87 beta, right, from our sequential shrinkage for the S&P 500. So I'll ask you to keep that in mind. And we'll look at the next slide, which is we're going to take a look at these Fama-French factor models. And we get a beta to the market of around 0.89. It's a little more in line with the liquid factor model. And we didn't do anything fancy with it, right? Like, we've got a slightly different index, crisp equal weight versus the S&P 500, but we just said let's prefer that. Let's do that first. The Fama-French models don't have any of the yield curve or credit or vol instruments, break-even inflation. Does that, but it does, the five-factor model does have this sort of RMW and CMA. They both also have this Carhart momentum factor. Does that help them? A tiny bit, 76% versus 74%. Now, you might say, okay, well, that's not that big a deal. I'll also add the fact that if, a lot of research, when you estimate what the cost is to implement, one of the factors like SMB or HML, cost is usually around 2 to 3% a year. If you want to trade futures, right, like with the liquid factor model, it's a lot cheaper. We're talking basis points. So, I'll also tell you this fund, incidentally, this fund, which seems to be exposed to equity markets, value, changes in the level of the yield curve, is Berkshire Hathaway, right? If you were to think of a value fund that's out there, this would probably be a good example. And interestingly enough, Warren Buffett has been telling us all along, hey, you probably should just hold some index funds. He's right. You could do that and you would get similar returns, right? So kind of interesting. So the model doesn't know who Warren Buffett is. It just sees the data, but what we get out of it isn't crazy. So now I mentioned that when we throw everything into these models, we can get some crazy betas. That's not just that one example. So here, what I've done is I've shown those three models, that kitchen sink where we just throw all the variables in and then recombine them. The sort of corrected covariates where I just throw everything, all the factors in, right? But I haven't done this sort of sequential estimation. And then, the sequential shrinkage versus the Fama-French model. And if you look, the red line is where we just throw everything in all together. And those are some pretty volatile, pretty crazy estimates of betas. Definitely not something you'd want to be hedging with and having to adjust month by month. There are firms that do this. I've spoken to, I've yeah, talked to people, and there are places where they're like, yeah, we just throw everything in and we combine them later. And this would tell you don't do that. Um, Even apart from that red line, if you look at this sort of cyan blue line versus the black line, there's still a good bit of variability sometimes, especially if you look at some of these yield curve factors, um, versus that black line that's a lot more calm. Um, you know, so that's a little troubling, right? What this says is that collinearity, even if you're going to recombine coefficients, even if you think you've done your feature engineering, um, it's still, this sort of preference still can calm your sort of estimates down and lead to less rehedging. Now, that's a picture. I can actually show you some statistics for this that'll help sort of explain that, and put some numbers on it. So a simple way is we can look at sort of the average of these coefficient estimates, because these are sort of rolling regressions versus their sort of volatility or their standard deviation, right? And if you look here with sort of what's bolded, most of the lower vol estimates are over here in the sort of full sequential shrinkage model. A little bit for some of the corrected covariates. So the feature engineering can be pretty helpful. That's one measure, right? And most of these are very similar or better, to some of the sort of results we see for the Fama French model. So it's also a pretty nicely behaved model. It's why it's lived for a long time. If you wanted to think of this as just a better implementation of Fama French, you're welcome to do that. You know, take it as you will. So that's one way to look at coefficient stability. There's a few other ways we can. So one of the things we can do is in these rolling regressions, we can just look at how much do the coefficients change, right? Just the absolute value of that change. And this is daily, so we're looking day to day. And if you look, I bolded where the smallest values are. Most of these, values are much smaller for this sort of full liquid factor model where we do feature selection and we do sequential estimation, right? That's nice. And in some cases, the absolute changes are much smaller. Sometimes very similar, but sometimes much smaller. Okay, well, we can dig a little deeper. So that's looking at the absolute changes of betas. But the truth is, you're probably not going to hedge all those exposures. You're going to look at which ones seem to be statistically significant. And if we look at the changes when we only hedge significant betas, it's even more crushing for the full sequential, the full liquid model, right? It's completely dominant. Now, to be fair, this could be a much harsher scenario, right? Because if we're only hedging betas that are significant, when a beta flips under that sort of cutoff of plus or minus 2 down to like a 1.9, we would go to the model essentially looking at this data, we treat it as a 0, and then it flips back over the line, and it's going to be a complete reinstitution of that hedge. You would probably do a little more sort of gradual sort of moving in and out of the hedge. But even in that harsh scenario, the changes are still smaller with the sequential model. So we do think that this does also reduce sort of unnecessary rehedging, right? Because each of those beta changes, if you were to hedge it, costs money, right? So this is sort of like this is sort of saying, hey, you'd be rehedging less, which should be saving you money. So that's good. I'll look also at a fixed income fund. I'm not going to name this one. It's just I honestly don't even remember. I just grabbed a random high yield fund. It has 22 billion in AUM. The manager's been there a while. It's decently rated, charging 58 basis points. Obviously, it's lower vol than an equity fund, but for a high yield fund, it's had some good days and some bad days, sort of plus or minus 4 sort of territory. So we'll take a look at this fund, and we're going to run that versus the same models, and a Fama French model. There is a Fama French high yield model, or not high yield, bond model. Unfortunately, they don't have the data on Ken French's website. And so we're going to have to substitute in some factors, but that'll be fine. So just like I did before, we're going to sort of try this kitchen sink versus the corrected covariates versus the sequential model and see, you see there is a fall off. For one thing, there's a little bit of a fall off in the R squared from 57.5% to just under 54. The estimation order changes, right? We know without looking at any data, without any cherry picking or sort of data sniffing, we know it's a bond fund. So what are we going to do? We're going to run yield curve factors first, and then credit, and then equity factors. And you can see that in this sort of column that has the ordering under sequential shrinkage, right? We try the level and the slope, then we go to credit, and then we go to this sort of yield curve, the bump, that sort of curvature or vol component. And what do we get? Well, this fund seems to be exposed to changes in the level of the yield curve, seems to be exposed a little bit to interest rate vol, right? There could be some sort of refinancing aspects there. And it does seem to be exposed to credit. The Fama French model, like I said, they don't have the data on Ken French's website, which is unfortunate. But the factors roughly line up. There's a slope factor, there's a credit factor, and it's sort of an IG-ish credit factor. There's an equity market, a size, and a value component. And interestingly, you sort of have to dig into a footnote, that Fama and French paper actually does something like this sequential estimation that we're doing. It fits everything but the equity factor together and then fits the equity factor from those residuals. So even this idea of sequential estimation in this context is not, it's not as crazy and out there as you would expect, but really lower R squared, not even quite 33%. I don't know if Fama and French weren't happy with the performance of this model, and that's why it's not on Ken French's website. It's really hard to find more information, but we have it as a point of comparison. Not bad here also. But it's a little shocking to see the lower R squared. Even if we look at the liquid factor model, R squared of 54% is okay. But the question is what's going on? And if you think about this, if you remember back to when you learned about fixed income or when you first started working with fixed income, bonds are like puppies. They get issued, everyone looks at them, everyone's excited about them, they fawn over them, and then a lot of them go away. They find their forever homes and insurers and pension funds and endowments, and they stay there for the rest of their life. And so that liquidity falls off. And what that means is that price updates sometimes lag a little bit, right? So maybe we need to look at monthly returns, or maybe we need to look at sort of some lags of a couple days just to capture the full effect. This can get complicated quickly. That said, just moving to monthly returns is pretty straightforward. So there's different things you can do. So if we jump ahead, I'm just going to try monthly. It's easy, it's simple. And what we see is the R squareds do improve a lot. So to the extent that we think there might be some pricing lags or some sort of, maybe liquidity issues, this helps. We go from sort of in the 50s to, R squareds in the sort of 85 to 95% region. There is an effect that you will see, though, and this is something that I've seen pretty consistently. This is something we're still looking into, which is when we move from daily to monthly, we tend to see the explanatory power shift from high yield factors to IG. And our best guess at this is economically driven. We think that what's probably happening is that the high yield factor is more sensitive. It's like the canary in the coal mine. But if it is a big factor or there is a big sensitivity, that as that accumulates over time, that starts to manifest in the less liquid IG markets. And so that's maybe why we see this shift when we look at monthly returns to an IG exposure, right? This does help the sort of Fama French factor or model that we've endowed with liquid factors as replacements for the data, right? We get up to a 73% R squared, but still not sort of the performance we would typically expect. Now, since these are all liquidly tradable, that intercept term, can you think of that as alpha? Yeah, it's probably one of the better proxies we'll get. It is significant. Unfortunately, it's significantly negative, which is that's unfortunate. So, not exactly what you'd hope to see, but there you go. So yeah, there are things we can do. If we think that our returns are a little less liquid, we can shift to monthly. That still gives us plenty of data because our factors are fairly orthogonal. Even having a little bit less data, we still can make decent inference. So that's the conclusion. We're a little near time. There are some additional spicy results that I have, which we probably won't get into, but I can give you a little summary, which is I grabbed just a handful of quant funds that had high fees because you would think you're paying high fees for quantitatively managed assets. There should be some alpha there. And some of the funds are hard to explain with these delta one factors. Like some of them, you're not getting above an R squared at 33% or so, but some are actually very well explained by these liquid factors, and you're getting T-stats on betas of 30s to 60s, which is sort of starts to look a little indexy. And it's not clear that any of them has significant alpha. So this idea that we're always struggling with is, do hedge funds and PE and private credit and all these people, do they have alpha, or is it roughly the same as these public instruments that we're trading? I don't have the answer for that for you. It seems like maybe they're similar, but who knows? But at least we have a tool that can get us a little better of a look now. So hopefully I've convinced you that, multicollinearity is something to take really seriously. It really challenges how we interpret our models, and it can really mess up our coefficient estimates in a way that we can't just, it's like Humpty Dumpty. We can't put it back together again after the fact. We can't just take these pieces and put them back together and get sensible betas. What we get is weird. And that could be real trouble if we're hedging based on these coefficient estimates. So if we do our feature engineering well, and if we think about how we do our estimation, we can get rid of a lot of these problems. And we get results, what we think of as exposure estimates that are a lot more stable. And ideally, that's going to reduce sort of needless hedging. The other thing that's really interesting here, and this sometimes surprises some of the academics, the fact that equity funds have exposure to yield curve measures in some cases. I've talked to clients where they say, well, how could that be? And I said, are you over or underexposed to real estate or durables? And then they kind of smile. They're like, okay, I see what you're saying. And it's sensible. When we go back to DCF, there is a risk-free rate in there. It should have a time subscript. So it is related to the yield curve. So that can creep in. We also get corporate bond portfolios that are exposed to market beta or size and value. So single asset portfolios can have cross asset risks. We get what's nice here, we get something that's a lot like linear regression. We have T statistics, so we can look at which factors are significant and pay attention to those, and the ones that seem to be noise, we don't have to think so much about. So that's a little more of a reduction in complexity. It's a little different from linear regression, but not a lot different. There is still work we're doing. There's ongoing work with how we deal with illiquidity. That high yield to IG shift, I would love to see if we can find some theory that explains it. We have also done some work sort of relating these to some of the common latent factor models that are out there, like bar and Aladdin. And if we do constrain it in similar ways to bar, we get pretty similar results. But we have statistical significance. We have some other factors that aren't in the bar model, so that's kind of nice. So with that, I'll leave it and see if there's questions people have or whatnot.
Thank you, Dale.
Mhm.
I don't show any questions in the chat room, and I haven't had any emailed to me. If
I've
anyone has
convinced
any
everyone.
if you have any questions, if you'd like to go ahead and pop those into the chat room, I'd be happy to convey those to Dale or to Greg.
Thanks, Tiffany. And if there are any questions that come up after the fact as you're digesting the information, please feel free to reach out. We do have, a white paper that covers a lot of the material within the presentation in easy to digest form that's been helpful for some of our clients and prospects. So if there were no questions, Tiffany, did want to thank you for the opportunity to present here today. Hope it was educational for some folks.
Yep, Greg, let me interrupt for 1 second. We did just get a question. The
Sure.
question is, when you talk about hedging, do you mean it literally, or is it notionally that you could hedge a fund risk? For example, BRK-A, if
Mhm.
one wanted to.
So we can hedge this in the sense that, like, if there's a fund and you don't want the beta, you just want the alpha, you could hedge that out, to a first order approximation. Could you use this to try to replicate a fund? You probably could. There's that alpha component, though, is gonna be a factor into how well you can do that. Do we get people that use this for hedging? Yeah, absolutely we do. A lot of times, though, that's done benchmark relative. So a lot of these analyses we will do benchmark relative, sort of trying to sort of explain tracking error versus the benchmark, which is another way you can do this.
Right. Pardon me, they elaborated.
Okay.
They meant that funds risk, an example for Berkshire Hathaway.
Funds risk is in funding risk,
It said,
or
let me reread it for you. When you talk about hedging, do you mean it literally, or is it notionally that you could hedge a fund's risk? For example, the
oh, okay,
Berkshire
okay.
Hathaway, if one wanted to.
It's literally, and this is, the problem we always have with modeling. The world will change as we move forward. Hopefully it changes less here. We've tried to make it so these coefficient estimates don't change as much. So you could hedge that out. But there is always that possibility of a change. So you can hedge it to a first order approximation, but to the extent that those exposures change, that won't be hedged.
So I think it's a great gesture from Qatar.
So I don't know if that,
Yeah,
hopefully that
Michael, yeah.
Put down that kind of an offer, but I could be a stupid person saying, no, we don't want a free.
Hey, Michael, I'm going to go ahead. Michael, you're off mute.
okay. I was going to say too, I'll add to what Greg said. There is also a paper up on SSRN. It's pretty transparent, and I say that in the sense that we've now had 2 clients that have actually, implemented this, and they've come back and they said, yeah, we've largely replicated what you've done. It makes sense. I think your interpretations, help. So, if you want to check our work, I'm glad to have people check my work. Which isn't always easy. I know, like, we've all tried, and those of us who tried to do paper replication, sometimes it's really hard, but that is out there. You should be able to look that up, and you should be able to replicate it if you want.
Thank you, Dale.
Yeah.
I think that's it on our end and with the emails. But so anything else, Greg, Dale?
No, I think this was great. Tiffany, thank you
Yeah.
for the platform and opportunity to present Dale's research. And like Dale had referenced, let us know if there's any interest in digging deeper into the white paper. We've had a couple of people actually use it to implement on their own. Not the way we typically operate, but sometimes when you put out creative research, people use it in different ways. So we're open to different ways to go about implementing these ideas. But just wanted to say thanks again for the opportunity today.
Sure. And thank you again to Parametric, a subsidiary of Morgan Stanley. We appreciate having you and Dale on with us today. And we'll be sending out a survey after this with a recording of the session. So if anyone has any other questions, feel free to email back to the link that was sent to you. And I hope you all have a good day.
Thank you, Tiffany.
Yeah,
Thank
thank you so
you.
much.
Bye-bye.